Now speaking, Matt Hodges, Vice President, Investor Relations. Ken Hicks, Executive Chairman of Academy Sports and Outdoors, opened the first quarter 2023 financial results call by thanking those in attendance. He then reminded us that statements made during the call could be considered forward-looking statements which are subject to risks and uncertainties, and that the company had no obligation to revise them. He also noted that certain non-GAAP financial measures would be referred to in today's remarks, and those reconciliations could be found on the company's website. With that, he turned the call over to Steve Lawrence, Chief Executive Officer. Now speaking, Ken Hicks, Executive Chairman. Academy Sports and Outdoors announced a Board of Directors leadership succession plan in April, which took effect June 1, 2023. Steve Lawrence is now the company's Chief Executive Officer and a member of their Board of Directors, while Michael Mullican is now President of the company. The board and former CEO are confident that Lawrence and Mullican will lead the company to new heights of operational and financial performance. Lawrence and Mullican both had significant contributions during the transformation of the company over the last 4 years, and they are all aligned with the executive committee on their vision, mission, and values. Former CEO thanked the team members, executive committee, and board of directors for their dedication and support during his time as CEO. He also thanked shareholders for their confidence and trust in Academy. Lawrence will be responsible for executing Academy's strategy to become the best sports and outdoors retailer in the country, while providing fun for all and creating value for their stakeholders. Now speaking, Steve Lawrence, Chief Executive Officer. Academy reported a negative 7.3% comp versus the same quarter in 2022 with net sales of $1.38 billion. Factors contributing to this decline include macroeconomic headwinds such as higher costs on virtually everything, fewer transactions compared to last year, and unfavorable weather patterns in several major markets. Apparel was the best performing business, up 1%, while footwear was down 2%. Sports and recreation declined 3%, with team sports and outdoor cooking being the strongest performers. Outdoor was the weakest division with sales down 15%. Adjusted net income decreased 33% to $103 million or $1.30 per share, partially due to a 110 basis point decline in merchant margins. Inventory increased 4.7% compared to Q1 of 2022 and is well positioned for the summer selling period. Academy expects customers to continue to be thoughtful in their spending and has increased its focus on positioning itself as the everyday value leader. Now speaking, Michael Mullican, Executive Vice President, Chief Financial Officer. Ken, the outgoing CEO of Academy, has built a culture of success, and Steve is taking over as president. Net sales for the quarter were $1.38 billion, with comparable sales of negative 7.3%. Gross margin was $467.1 million with a rate of 33.8%, a 170 basis point decrease from the first quarter of last year due to lower merchandise margins from greater promotional activity and higher shrink costs. SG&A expenses were $340.9 million, or 24.6% of net sales, an increase of 310 basis points compared to the previous quarter due to an increase in stock-based compensation, new store expenses, and technology investments. Net income was $94 million, or 6.8% of net sales, resulting in GAAP diluted earnings per share of $1.19 per share. Adjusted diluted earnings per share were $1.30 per share. At the end of the quarter, Academy had $296 million in cash and no outstanding borrowings on its billion-dollar credit facility. The company is on track to open 13 to 15 new stores in 2023 and recently approved a dividend of 9 cents per share, payable on July 13, 2023. For the remainder of the year, Academy is taking a more cautious view and have taken several actions to help drive the business, including increasing their focus and strengthening their position as a value provider in their space, managing inventory levels, controlling expenses, and supporting growth initiatives. Fiscal 2023 guidance includes net sales of $6.17 billion to $6.36 billion. Comparable sales are expected to range from negative 7.5% to negative 4.5%. Gross margin rate between 34% and 34.4%. GAAP income before taxes is expected to range from $675 million to $750 million. GAAP net income between $520 million and $575 million. GAAP diluted earnings of $6.50 per share to $7.20 per share. Adjusted diluted earnings per share, which excludes certain estimated expenses such as stock compensation, are expected to range from $6.80 per share to $7.50 per share. Capital expenditures are forecasted range from $200 million to $250 million, and adjusted free cash flow of $400 million to $450 million. Now speaking, Steve Lawrence, Chief Executive Officer. This company has a plan to move forward despite macroeconomic challenges, by introducing new brands and ideas in the back half of the year, increasing traffic through upgraded targeted marketing, leveraging their new customer data platform, opening new locations throughout the year, enhancing omni-channel functionality, and applying the lessons learned from Q1 toward driving sales and improving profitability. They also plan to invest in and deliver against their long-range plan, which is to expand their store base into new markets, build a more powerful omni-channel business, and drive growth from existing stores with improved service and productivity, an improved merchandising assortment, and engaging customers. Oppenheimer and Company analyst Brian Nagel inquired, "Could you help us understand the impacts of weather on your sales in Q1?" Steve Lawrence replied, "In response to the question, I'd like to emphasize that while we have seen a pullback in early Q1 due to customer issues, we are still tracking 28% ahead of where we were in 2019. We experienced our best quarter in February and saw some headwinds emerge in March and April, particularly in the surge categories. However, with weather opening up across the country, we've seen some of those categories come back. We're also looking forward to new initiatives coming this year such as new brands, stores, customer data platform, and vintage from 2022, all which could impact the back half of the year. We remain confident that the business will improve as we progress through the year." Michael Mullican replied, "Given the cooler temperature across our footprint, we saw a significant impact on sales. We were soft in margin-rich categories like patio and pools, resulting in lower margins overall. While promotions played out as expected, missing the early selling season with these seasonal categories had a negative impact on gross margin. Outdoor fulfilled our expectations, but the lack of soft goods sales hurt our margins even further." Oppenheimer and Company analyst Brian Nagel inquired, "What is the reason for no change to gross margins in the new guidance, despite weaker margins in Q1?" Michael Mullican replied, "In response to the question, I can say that our outlook on gross margin hasn't changed and that we're only 20 basis points off our annual guide. The bulk of that miss was due to seasonal categories, while a significant portion was from shrink, which was worse than expected. We have implemented a number of tactics to combat this issue and are making good progress. Additionally, we anticipate a freight benefit in the back half of the year and some other supply chain savings, which should help us to reach our goal of 34 out of 34.4 by the end of the year." Goldman Sachs analyst Kate McShane inquired, "Can you provide more details on the new initiatives and lessons learned from Q1 that will lead to an improved top line in the second half of the year?" Steve Lawrence replied, "The first quarter saw a tale of two cities. Soft goods such as apparel and footwear were relatively flat, whereas hard goods such as outdoor and sports direct were down 10%. Customers responded to value, newness and innovation, regardless of price, and improved in stocks. Big-ticket items with long replacement cycles such as treadmills and kayaks were not as popular. Moving forward, we will be leaning into these areas that customers responded to by delivering value through everyday pricing, marketing and providing newness and innovation. We are also planning our long lead time replacement cycle businesses accordingly." Michael Mullican replied, "Despite a challenging quarter, we have continued to invest in the business, specifically launching customer-targeted marketing initiatives. We are confident that these initiatives will start driving value in the back half of the year and are continuing to invest in omni-channel technologies. Cash flow remains strong, allowing us to make these investments, and we anticipate receiving sales benefits in the back half." Goldman Sachs analyst Kate McShane inquired, "Can you provide an outlook on when the big-ticket, long replacement goods category might stabilize or inflect?" Steve Lawrence replied, "As we move through the remainder of this year, we anticipate some of the headwinds to ease. Demand is still strong, but should level off closer to the holiday season." Michael Mullican replied, "We are not taking a passive approach here. We have seen success in outdoor cooking, and we have leveraged those learnings to drive meaningful growth in other major categories. We are committed to thoughtfully merchandising, presenting, and offering good value to our customers in order to continue to drive positive gains." Ken Hicks replied, "We have seen an uptick in the big-ticket category, particularly in paddle marine. As the season progresses, we anticipate increased demand for this product from customers." Bank of America Merrill Lynch analyst Robbie Ohms inquired, "Can you provide some more color on 2Q same-store sales and how they compare to the first quarter? What initiatives are in place for the back half of the year that could potentially improve same-store sales?" Steve Lawrence replied, "We saw a deceleration in the business in April and May that is reflected in our guidance. However, as we move into the summer months, we expect to see seasonal headwinds die off and our initiatives such as the CDB, brand initiatives, store initiatives, and launches start to level off. We will also see some effect from the surge activity, although we are still up against some big surges last year and in the first half of this year." Michael Mullican replied, "The high end of the guide is something that we think is achievable. We believe we are well positioned to reach the upper end of our guidance range. We have observed a gradual decrease in consumer demand, however, we have been able to adjust our expenses accordingly and stay on track. In April, the decline was so drastic that it was difficult for us to react in time, but now, with an understanding of the forecast, we believe the upper end of the guide is attainable." Bank of America Merrill Lynch analyst Robbie Ohms inquired, "Can you provide more details on the new brands and categories your company is introducing?" Steve Lawrence replied, "We have altered our plans slightly and will be announcing further details during our upcoming Q2 earnings call. We always aim to provide timely updates to customers, and so it is best to wait until closer to the date for any new information. Customers should expect apparel and footwear in the back half of the year." Michael Mullican replied, "Interesting question. We have consistently seen vendor control of distribution as a benefit to our business. That being said, Nike's return to Macy's is not unexpected, and we don't anticipate it impacting us too much since all of our locations are off-mall." UBS analyst Michael Lasser inquired, "Why is Academy losing market share compared to its larger competitors? What can it do to address the factors driving underperformance?" Steve Lawrence replied, "We track our market share across multiple categories using data from Circana, NPD, and other resources. We're not losing market share, rather picking it up in almost every category. Our mix of business is different than some of our competitors. We are 54% hard goods and 46% soft goods. Long term, we believe having a diversified assortment will be beneficial to our success versus being overly focused on one or two categories." UBS analyst Michael Lasser inquired, "What assumptions have you made for promotions and shrink in the back half of the year, given the freight benefit which will offset it? How will increased promotions and longer-term shrink impact the improvement of sales?" Steve Lawrence replied, "I can say from a promotional standpoint, we've seen an increase in merchant margins being down 100 basis points in Q4 and 110 basis points in Q1. This is more promotional than it was pre-pandemic, but still not back to the levels we saw before. We have incorporated this into our guidance for today's call. In terms of shrink, do you have any thoughts?" Michael Mullican replied, "We are expecting shrinkage to remain about the same as it is now. We have taken proactive steps to improve this and have already accounted for most of our inventory for the year, so we do not anticipate any major changes in this area." J.P. Morgan Chase & Company analyst Chris Horvers inquired, "What expense cuts have you implemented to offset the costs associated with store openings and supply chain initiatives?" Michael Mullican replied, "Our team has a long history in the retail industry and is prepared to make necessary adjustments in order to remain competitive. We have identified opportunities for further cost savings, including reducing task labor in stores and scaling back planogram resets. All while continuing to invest in our business. Cash flow remains strong. We are confident that we can cut out any unnecessary expenses and come out of this situation in a better position than expected." Steve Lawrence replied, "I wanted to emphasize that we are carefully managing our spending and remaining focused on our long-term growth strategy. We're balancing short-term financial discipline with the necessary investments for long-term success." J.P. Morgan Chase & Company analyst Chris Horvers inquired, "What strategies are you utilizing to increase advertising for the back half of the year, and what is enabling this shift in approach?" Steve Lawrence replied, "We've invested in a new customer data platform that will make us more agile when it comes to targeting customers. Our data had previously been siloed in multiple databases, which made it difficult to target, market, or send triggered emails based on customer behavior. We expect this platform to come online at the end of Q2 and provide us with better segmentation and targeted messaging capabilities." Michael Mullican replied, "Investment in refit technology and better truck utilization will help us manage our inventory more efficiently. We have a number of different scenarios built into our guidance and feel confident in where we are today. Our ability to quickly pivot early in the year gives us an added advantage." Steve Lawrence replied, "Yes, we don't want to see a slowdown in the market. However, this allows us the opportunity to react quickly and prepare for the rest of the year. Michael and I have been discussing how we can best approach this situation." Evercore IC analyst Greg Mellick inquired, "What was the primary cause of the ticket and transaction count declines in the quarter? Was it a decrease in traffic, a decrease in average ticket size, deflation, or items being removed from the basket?" Steve Lawrence replied, "Our overall transactions were down, but our has remained relatively flat. The decline in basket size is largely due to a pullback in big-ticket purchases and an increase in sales of lower-priced apparel and footwear." Michael Mullican replied, "The consumer market has softened, and this, coupled with the surge in ammo activity we had last year, has affected our transaction side." Evercore IC analyst Greg Mellick inquired, "Is SG&A expected to be up or down on a same-week basis in the second quarter?" Michael Mullican replied, "Our advertising and new store growth helped us to post higher quarterly earnings. We have seen a decline in the job rate, but we are confident that we can adjust our variable expenses and other takeouts in order to remain on track with our rate predictions for the second half of the year." Morgan Stanley analyst Jackie Sussman inquired, "How have the sales of durable categories such as fitness equipment performed in 2019 compared to previous years, and has this impacted your outlook for 2020?" Steve Lawrence replied, "Overall, we have seen an average increase of 28% compared to 2019. Apparel, sports and recreation and outdoors are up 27%, 36% and 29%, respectively. Some categories have even had higher growth, such as ammunition with a 100% increase. The only category to have seen softer numbers was fishing, which is still tracking closer to 2019 but not below it. Looking ahead to 2024, we need to focus on 2023 before making plans for the following year. Morgan Stanley analyst Jackie Sussman inquired, "Are you seeing any signs of trade down in your good, better, and best mix?" Steve Lawrence replied, "We've seen customers gravitating toward value-oriented offerings such as private brands, clearance items and promotions. We also observe customers seeking out newness and innovation. We are focused on ensuring both value and innovation are provided in our products to meet customer demands for quality at a reasonable price." Wells Fargo Securities analyst Kate Fitzsimons inquired, "What impact do you anticipate the recent organizational changes having on the company's growth trajectory?" Wells Fargo Securities analyst Kate Fitzsimons inquired, "What KPIs are you evaluating for accelerated store growth, and what is your strategy to reach 120 to 140 stores by 2024 to 2026 given the current business environment?" Michael Mullican replied, "Our cash flow remains strong compared to our peers, which is allowing us to fund our growth from operations. The 2023 vintage is already accretive to cash flow, and we are pleased with the progress of our new store program. We tested and learned in 2020 and have applied those learnings in 2021. Initial read on Lafayette and soon Peoria has been encouraging. We remain bullish on our new store opening program and ROIC ramp." Steve Lawrence replied, "Our 22 vintage looks strong from a financial perspective. We anticipate that our earnings will be up substantially year over year, with increased revenue and margin expansion. We view this as a positive indicator of the company's overall health and long-term sustainability." Michael Mullican replied, "Our portfolio is performing well, with 20% growth already achieved and cash flow becoming accretive 8 months on average after launch. This indicates the strength of our program and the success of our portfolio." Wells Fargo Securities analyst Kate Fitzsimons inquired, "Can you speak to your appetite for stock buybacks in light of reset expectations on the top line this year?" Michael Mullican replied, "Our priority is to maintain a strong balance sheet, so we're taking a cautious approach in this environment and staying nimble and flexible. We have a capital structure that can withstand most economic cycles, and when we have excess cash, we'll return it to shareholders through buybacks. In the first quarter, we felt the stock was undervalued and that buybacks were an important part of our capital allocation policy." Loop Capital Markets analyst Anthony Chukumba inquired, "Do you believe U.S. income tax returns and refunds being down 10% impacted your first quarter performance in any way?" Steve Lawrence replied, "Yes, I believe that the combination of tax refunds, consumer debt at an all-time high, and the threat of a debt ceiling played a significant role in our performance this quarter. These factors created headwinds that affected our overall results." Loop Capital Markets analyst Anthony Chukumba inquired, "Given your updated guidance, is the reduced free cash flow still sufficient for you to commit to stock buybacks this year?" Steve Lawrence replied, "Anthony, our business is generating a significant amount of cash. We are committed to executing our strategy and will prioritize stability and agility when making decisions. We will use the cash to fuel investments, and if we are left with any additional funds, they will be returned." Steve Lawrence replied, "Our stores are performing well even in a challenging environment. We've run profitable stores at $11 million and all of our current stores are well above that range. As such, we're able to generate a lot of cash and remain committed to returning it to our investors." Stevens Incorporated analyst Dan Imbro inquired, "Hey, good morning everyone. Could you tell us how the recent port delays on the West Coast and the current inventory levels affect your business?" Steve Lawrence replied, "Michael and I have noted that our inventory is back at optimal levels across a wide range of product categories. We are monitoring the seasonal slowdown in a few places, but it has not caused any inventory issues. In terms of the supply chain disruption on the West Coast, we have worked to diversify our ports, so we have not experienced any negative impacts." Michael Mullican replied, "Despite disruptions on the West Coast, we maintain a competitive advantage as we don't bring them into the West Coast. Any industry-wide impact will be indirect for us. In terms of inventory, per store, it's down compared to last year with no significant holds." Stevens Incorporated analyst Dan Imbro inquired, "Could you quantify the cost savings of the changes that were made to your SG&A outlook, and how aggressive or conservative is this outlook in terms of further cost reductions for the year?" Steve Lawrence replied, "Yes, we have identified the issue. We included it in our guidance as a result of this recognition and plan to continue with our initial rate outlook for the year. Our team is experienced in navigating through various economic cycles and is prepared to pivot where necessary." Wedbush Securities analyst Seth Basham inquired, "Could you please provide some color on the gross merchandise margin and the components that drove the decrease in the quarter?" Michael Mullican replied, "We saw an increase in promotional activity, as well as a slight uptick in clearance sales this quarter. Unfortunately, this impacted our merch margin, and freight costs affected our gross profit." Wedbush Securities analyst Seth Basham inquired, "Can you explain how promos, merch margins, and shrink impacted the company's headwinds?" Michael Mullican replied, "Yes, our plan did play out the way we thought it would. However, there was a slight decrease in merchandise margin due to a shift towards fewer seasonal sales from outdoor pools and water sports and recreation items as well as some soft goods." Steve Lawrence replied, "Our business is primarily focused on delivering everyday value to our shoppers. On average, promotions and clearance make up less than 25% of our business, while 75% is based on offering stable prices." Steve Lawrence replied, "I understand the disappointment of our results this year, but I want to reassure our audience that we are taking action. We are making sure that we meet our goals for the remainder of the year, and we are staying focused on our long-term strategy. We have a model that customers like and is scalable and transportable, so that we can bring the Academy into as many towns as possible." I will now hand it off to Ken for closing remarks. Ken Hicks replied, "Thank you, Steve. We have an experienced team with a clear plan and a strong foundation to move forward. Our strategy is to grow through the expansion of new stores, primarily in new markets, which will provide volume without cannibalizing existing markets and increase our reach. We are also investing in our omni-channel business to make it easier for customers to shop and target consumers better. Our team is up to the challenge, and I'm confident in their ability to continue driving our mission and vision of becoming the best sports and outdoors retailer in the country. Thank you to all Academy team members for their work, and investors for their confidence."